Hi, I'm Mike Gassewitz, CEO of TriCert Financial Group. Welcome to another episode of InFocus. Today we're going to get an update on our financial sector, and I'm joined by Lee Grimshaw, a portfolio manager responsible for that sector. Welcome, Lee.
Thank you, Mike. How are you?
I'm doing great. A little chilly out, but getting ready for Christmas, and so it seems very appropriate.
Yeah.
So, financials. Why don't we dive into it? And we always like to first talk about how are, the core picks, and let's look at them first from a business perspective, and then secondly, we'll look at how have the markets reacted to that. So let's talk about our core picks and how are they doing from a business perspective?
Yeah. So the banks are an exceptional place to be right now, and our core picks in particular are an exceptional place to be, and really from a top banking perspective, all of our core picks have really been top quartile of the returns and the business perspective across the board. So companies like JP Morgan, Goldman Sachs, Morgan Stanley, and Bank of America have all had, in particular in the U.S., have had outstanding results and have beat materially the consensus EPS. And more importantly, the year-over-year growth across the board has been roughly north of 30% in each case except for JP Morgan. So that's been exceptional because returns tend to follow the fundamentals. And as much as beating the expectations of EPS is important, the year-over-year growth profile is also important. Equally, the Canadian banks have also done extremely well, just a slightly lower on the growth profile, more like north of 20% from a growth perspective, but all beat the consensus EPSs as well. The only negative in Canada compared to the U.S. is really the loan loss commentary, and so that's a result of the higher interest rates and the mortgage renewal cycle, and then obviously the macro issues that unfortunately the States has presented to us today. So there's a bit more of a forecasted expectation of losses, which has to be reserved for in the Canadian context versus the U.S.
Yeah, good points. And I guess if we look at things from a bit of a macro perspective, the Fed in the U.S. has now finally started to lower rates. Do you see that, back to the losses? Do you think that might give some relief on that front, or I guess it's too early to tell?
It's early to tell, but I would say there would have to be a material move, a more material move in the rates, I think, to buffer that, because when you came out of the decline in rates out of COVID, your mortgage rates were as low as high twos, and we're still at the high 3s, 4% range from that perspective. So we'd have to see probably 100 basis point move in that needle before that really happens, and that's quite possible. Do I think it's tomorrow or this week? I doubt it. But maybe within the next year, 50 basis points maybe is in the cards, but we'll have to see.
Fair enough. So that's a good view on the banks and their businesses. Let's say, what else in the financial sector? Let's say insurance companies. How are our holdings doing there?
Yeah, they're doing okay. Insurance as a whole has been, I would say, slightly more mediocre in terms of the return profile. And part of that is there's an initial bump when you get a reduction in interest rates because they tend to hold larger portfolios of bonds. But that's been buttressed a little bit because the rates have flattened out, and then you get this tension in the States with respect to from the political background in terms of trying to push for a reduction of rates, and the Fed pushing back, and in Canada a little bit more independence, or at least that's my perception, and we haven't reduced the returns as much. So it was good at first, but not bad, not a bad overall return. So and the ROEs are okay, and I did fail to mention that that is one thing that we look at quite closely is really two ratios with respect to both banks and life cos. We look at the ROE or ROTCE, which is return on tangible common equity. We think of it as a bit of a steak analogy in terms of the quality of the steak that you're serving up. And we think about the balance sheet, in the case of financials being the CET1 ratio, as the size of the steak. And we want quality and we want quantity. And ultimately, those two factors factor into the amount of dividends and share buybacks that you get. So that's ultimately the cooked steak that you get within the whole dinner menu, so to speak.
Okay, I love the analogy. I'm all about meat, but okay, great analogy. Okay, so sounds like things are business-wise doing reasonably well. So talk about the markets and their reactions.
Yeah, so the markets, as I said, they tend to follow fundamentals. And given the growth rates, I think it's really been healthcare, materials, and financials that have led the sector pack across the S&P 500. Our core pick return profile is 30%, as is our healthcare return profile at 30%. The global index of financials is 23, so a slight outperformance for sure. And then for the sector of healthcare, that was 15. And I'm not a healthcare sector expert, but just providing a fundamental comparative at the end of the day. So that's been a good result, and a lot of it is a result more of the bank profile than it is of the insurance profile, as I indicated earlier. And so that's been refreshing.
Yeah, nice to see some diversification there happening even within a sector, right? Between the banking and the life cos, for example. So that's good. So looking forward, what are the things you're watching for?
Yeah, I think the big thing, especially for the Canadian banks, is going to be loan loss reserve ratios, a decline in the major tailwinds for the banks in both Canada and the U.S. have been the investment banking side or the capital market side of the balance sheet. And then we're going to be looking closely at the commercial banking, which is really a bellwether for the economic growth of the nation. And so we'll be looking at that to see how fast those particular indicators are moving or slowing down, one of the two, either increasing or decreasing. And so we see a little bit, as I said earlier, in the Canadian system. In the U.S. system, other than J.P. Morgan, which had a slight increase in their loss reserves, the loan loss reserves were absolutely flat last quarter. So I think that bodes well for the economy in the States. And if you're a believer that, generally speaking, and I know there's a growing disconnect here, but as the U.S. moves, so will Canada at the end of the day, because our economies are still integrated. So I still think we'll be fine. And I think ultimately, if there are cracks in the system, to your earlier point, Mike, in the Canadian system, I think the Bank of Canada will react and give a little bit of more relief on the interest rate profile, so that we don't break the system, so to speak.
Well, thanks for this, Lee.
Yeah, no problem. And thank you for inviting me on once again.
Folks, as always, if you have any questions, don't hesitate to reach out to your financial advisor at your CPA firm, or talk to your portfolio manager at TriCert Investment Counsel, or don't hesitate to reach out to myself. Take care.